Episode 5: Risk Management. Protecting your portfolio and staying in the game. Understanding risk and how much to take. Disclaimer. This content is for educational purposes only and is not financial advice. Always do your own research or consult a licensed financial advisor before making investment decisions. If you want to last in investing, forget about chasing the highest return. The real secret is staying in the game long enough for compounding to work its magic. Risk management is your seatbelt, your airbag, and your insurance policy all rolled into one. 1. Why risk management matters more than return chasing. It's easy to be seduced by high returns, but without proper risk control, you won't keep them. History is full of investors who made huge gains only to lose it all in the next downturn. Data point. Between 1926 and 2022, the S&P 500 returned an average of approximately 10% annually, but the average investor only earned approximately 6 to 7% according to Dalbar. The gap is mostly due to poor risk management and bad timing decisions. Key lesson. Protecting against big losses is more important than maximizing gains. A 50% loss requires a 100% gain just to break even. 2. The 3 core types of investment risk. Not all risk is created equal. Understanding the main categories will help you address each one differently. Market risk. The risk of your investments losing value due to economic downturns, geopolitical events, or recessions. Inflation risk. The danger that your money loses purchasing power over time. Even safe cash can be risky if inflation is higher than your returns. Behavioral risk. The tendency for human emotions to cause bad decisions, panic selling, overtrading, chasing fads. Example. In March 2020, the market fell 34% in a month. Many investors sold at the bottom, locking in losses, and missed the rebound that followed. 3. Measuring and understanding volatility. Risk isn't just about losing money, it's about how much your investments can swing. Standard deviation measures how much returns vary from the average. Higher equals more volatility. Beta measures how much an investment moves compared to the overall market. A beta of 1 moves in sync with the market. Higher than 1 moves more, lower than 1 moves less. Data point. From 1970 to 2022, U.S. small-cap stocks had an average annual return of approximately 11%, but with nearly double the volatility of large-cap stocks. 4. Drawdowns and recovery times. A drawdown is the drop from a peak to a trough in your portfolio value. The deeper the drawdown, the harder it is to recover. Examples. A 10% loss needs approximately 11% gain to recover. A 50% loss needs 100% gain to recover. The Nasdaq took over 15 years to recover from its 78% drop in the early 2000s. Action tip. Before investing, ask yourself, could I emotionally and financially handle this kind of drawdown? 5. How much risk should you take? Your risk tolerance is personal. It's a combination of capacity, your financial ability to take risk, income stability, time horizon. Tolerance, your emotional ability to handle portfolio swings. General guidelines. Longer time horizon equals can usually take more risk. Shorter time horizon equals should focus on capital preservation. Rule of thumb. 110 minus your age, for percent in stocks, with the rest in bonds or safer assets. Adjust for personal circumstances. Risk is the price you pay for returns, but unmanaged risk is the reason most investors fail. By understanding the types of risk, how to measure them, and how much you can truly handle, you set the foundation for every other part of your investing plan. The tools and techniques for controlling risk. Now, we'll dive into the practical techniques you can use to make sure your portfolio stays within your comfort zone, no matter what the market throws at you. 1. Position sizing. Controlling exposure from the start. One of the simplest ways to manage risk is deciding how much of your capital to put into any one investment. Fixed fractional method. Risk a set percent of your total portfolio on each position, e.g., never more than 2 to 5%. Kelly criterion. A formula that adjusts position size based on probability of success and expected payoff. Dollar cost averaging. Investing equal amounts at regular intervals to reduce timing risk. Example. Risking 2% per position means you'd need 50 consecutive losses to wipe out your capital, something that's extremely unlikely if you're diversified. 2. Stop loss orders. Knowing when to cut losses. A stop loss automatically sells an investment if it drops to a set price, limiting downside. Types. Fixed stop loss. Sell if price falls X% below entry. Trailing stop. Moves up as the price rises, locking in gains. Action tip. Keep stop loss levels logical. Avoid placing them at obvious round numbers where the market often tests prices. 3. Diversification. Not just stocks and bonds. Diversification is about owning different assets that don't all move together. Key areas to diversify. Asset class, stocks, bonds, real estate, commodities. Geography, domestic and international markets. Sector, technology, healthcare, consumer staples, etc. Data point. During the 2008 crisis, U.S. stocks fell approximately 37%, but U.S. Treasury bonds rose approximately 20%, cushioning diversified portfolios. 4. The danger of over-diversification, diversification. Too much diversification can dilute returns and make your portfolio harder to manage. Beyond approximately 20 to 30 individual stocks, or a few well-chosen ETFs, you often get little additional risk reduction. Example. Holding 100 different stocks that all track the same index doesn't actually give you more protection, it just increases complexity. 5. Case study 2008 crash. Risk controls in action. Investor A. 100% in S&P 500. Lost approximately 37% in 2008 and took 5+ years to recover. Investor B. 60% stocks, 30% bonds, 10% gold. Lost approximately 15% and recovered in under 2 years. Lesson. You don't have to predict the market. You just need a structure that limits catastrophic losses. Advanced risk control. Hedging, risk-adjusted returns, and stress testing. Now, we're going to add extra layers of protection, strategies that professional money managers use to cushion their portfolios from major market shocks. 1. Hedging, insurance for your portfolio. Hedging is about taking positions that rise when your main investments fall, offsetting losses. Common hedging tools. Inverse ETFs, go up when a specific index goes down, e.g., SHISH for S&P 500. Options. Buying, puts, gives you the right to sell an asset at a fixed price. Commodities, gold and silver often act as safe havens. Currencies. If you hold foreign investments, currency hedging can reduce exchange rate risk. Example. During the COVID crash in March 2020, gold rose about 4% while the S&P 500 fell over 30%. 2. The cost and trade-offs of hedging. Hedging is rarely free, options have premiums, inverse ETFs can decay in value, and safe havens may underperform in bull markets. Think of it like buying insurance. It costs money, but you'll be glad you have it when disaster strikes. 3. Risk-adjusted return metrics. It's not just about how much you make, it's about how much risk you take to make it. Key metrics. Sharpe ratio, return, risk-free rate, divided by volatility. Higher equals better risk-adjusted return. Sortino ratio, similar to Sharpe, but only penalizes downside volatility. Max drawdown, largest drop from peak to trough. Lower is better for capital preservation. Data point. From 1990 to 2020, the S&P 500 had a Sharpe ratio of approximately 0.52. A balanced 60/40 portfolio had a Sharpe ratio closer to approximately 0.6. Meaning slightly better returns for the amount of risk taken. 4. Stress testing your portfolio. Stress testing is running what-if scenarios to see how your portfolio might behave in extreme conditions. Methods. Historical simulation. Apply past crises, e.g., 2008 crash, to your current portfolio. Scenario analysis. Model hypothetical events, e.g., sudden 3% interest rate spike. Monte Carlo simulation. Runs thousands of random scenarios to estimate possible outcomes. Action tip. Even a simple spreadsheet simulation can reveal that your safe portfolio might drop more than you thought in a severe downturn. 5. Building a risk management plan. Write down in advance how much you're willing to lose before taking action. What hedges you'll use and when. How often you'll stress test your portfolio. What metrics you'll monitor to judge risk levels. Behavioral risk management and long-term discipline. Even the best technical risk management plan can be destroyed by poor human behavior. In fact, most investing mistakes aren't caused by lack of knowledge, they're caused by emotion. 1. Behavioral risk. The psychology of staying invested. Behavioral risk is when fear, greed, and overconfidence lead to bad decisions. Common pitfalls. Panic selling, exiting in a crash and missing the recovery. Overtrading, chasing every market move and racking up costs. Herd mentality, buying because everyone else is. Data point. J.P. Morgan's 2023 Guide to the Markets shows the average investor underperformed the S&P 500 by nearly 3% annually over 20 years, largely due to poor timing driven by emotion. 2. The role of a written investment policy. A written investment policy statement, IPS, acts like a personal constitution for your investing. It lays out your target allocation, your risk limits, your rebalancing rules, conditions for selling. Having it written down reduces the chance of making a big change based on temporary emotions. 3. Using pre-mortems to anticipate portfolio risks. A pre-mortem flips the idea of post-mortems on its head. Instead of asking, "What went wrong?" after a loss, you ask beforehand. "It's a year from now and my portfolio is down 25%. What could have caused it?" This forces you to identify and plan for possible risks in advance. 4. Automating risk controls. Where possible, remove human emotion from the process. Use automatic rebalancing to maintain target allocation. Set automated alerts for drawdown levels or valuation metrics. Pre-schedule contributions to keep investing through volatility. 5. Step-by-step risk management checklist. A practical process you can follow month after month. Review allocation. Does it still match your IPS? Check risk metrics, volatility, drawdown, Sharpe, Sortino ratios. Stress test. Apply at least one crisis scenario to see potential impact. Review hedges. Are they still needed, effective, and cost-efficient? Rebalance if needed. Bring portfolio back to target ranges. Update pre-mortem risks. Identify new threats. Confirm stop-loss levels. Ensure they align with current market conditions. Risk management isn't exciting, but it's what allows compounding to do its work over decades. Great investors don't avoid risk, they manage it.